Welcome. Today we dive into the fascinating world of real estate investment trusts, commonly known as REITs. Our focus? Understanding the impact of interest rate changes on REIT stocks and REIT ETFs. Interest rates are a fundamental aspect of any economy. They serve as the cost of borrowing and the return on lending, influencing the flow of money and credit in the economy. Shifts in these rates can send ripples across various sectors, including the world of investments. Enter REITs and REIT ETFs. REITs, or real estate investment trusts, are companies that own, operate, or finance income-generating real estate. They allow individuals to invest in portfolios of large-scale properties the same way they invest in other industries, through the purchase of individual company stock. REIT ETFs, on the other hand, are exchange-traded funds that primarily invest in listed REITs. Now that we know what we're dealing with, it's time to dive deeper into how interest rate changes can affect these investment vehicles. Enjoying this content? Don't miss out on future videos filled with even more tips, tricks, and inspiration. Hit that subscribe button now to stay tuned with us. Interest rates and REITs share a unique relationship. To understand it, we need to delve into the specifics. Interest rates, as you may already know, are the cost of borrowing money. They are a key factor in determining the attractiveness of real estate as an investment. When interest rates are low, the cost of borrowing decreases. This can make real estate investments more attractive because lower borrowing costs mean higher potential profits. Conversely, when interest rates rise, the cost of borrowing increases, which can decrease the attractiveness of real estate investments. Now let's bring REITs into the picture. REITs, or real estate investment trusts, are companies that own, operate, or finance income-generating real estate. They allow individuals to invest in portfolios of real estate assets the same way they would invest in other sectors, through the purchase of individual company stock. So, how do interest rates affect REITs? Well, REITs often rely on borrowed funds to acquire properties. When interest rates are low, REITs can borrow money at a cheaper rate to buy properties, which can lead to higher profits and increased dividends for investors. However, when interest rates rise, borrowing becomes more expensive for REITs. This can lead to a decrease in property acquisitions and development, potentially resulting in lower profits and dividends. Higher interest rates can also make other investments more attractive in comparison, leading to a potential decrease in demand for REITs. Moreover, the value of real estate may fluctuate with changes in interest rates. When interest rates are low, the value of real estate often increases due to the cheaper borrowing costs. But when interest rates rise, the value of real estate can decrease as it becomes more expensive to finance real estate purchases. As a result, changes in interest rates can significantly impact the performance of REITs, affecting their profitability, dividends, and overall attractiveness as an investment. So, we see that interest rates can have a significant impact on REITs. But how does this affect you as an investor? As investors, changes in interest rates can affect your REIT investments in various ways. Let's dive into this. When interest rates climb, it can lead to a decrease in REIT stock values. Why is that? Well, higher interest rates can increase the cost of borrowing for REITs, making it more expensive for them to acquire new properties or refinance existing debts. This increased cost can eat into their profits, which can ultimately lead to lower dividends for investors. And lower dividends can make REIT stocks less attractive, potentially causing their market value to fall. But what about when interest rates fall? It's the flip side of the coin. Lower interest rates can reduce the cost of borrowing for REITs, making it cheaper for them to acquire new properties or refinance existing debts. This can boost their profits, potentially leading to higher dividends for investors. And higher dividends can make REIT stocks more attractive, possibly driving their market value up. Now let's not forget about REIT ETFs. These funds can provide a level of diversification that individual REIT stocks can't. A REIT ETF invests in a broad range of REIT stocks, spreading out the risk. So even if some REITs struggle due to interest rate changes, others in the ETF might be doing just fine. This diversification can help mitigate some of the risks associated with interest rate changes. That being said, it's important to remember that REIT ETFs are not immune to interest rate changes. If rates rise across the board, the overall value of the REIT ETF could still take a hit, but the blow might be softened compared to investing in a single REIT stock. We've now seen how interest rate changes can impact REIT stocks and REIT ETFs. But how can you navigate these changes? Stay tuned as we delve into strategies for navigating the shifting sands of interest rate changes in the next segment. Navigating interest rate changes can seem daunting, but with knowledge and strategy, you can turn these changes to your advantage. So, how can one navigate through the unpredictable tides of interest rate changes? Let's dive into it. Firstly, diversifying your investments is key. A well-diversified portfolio can help buffer against the potential downsides of interest rate hikes. By spreading investments across various asset classes and sectors, you mitigate the risk of a single investment significantly impacting your portfolio's performance. When it comes to REITs, consider diversifying among different types of properties and geographical locations. Secondly, investing in REIT ETFs can be a smart move. REIT ETFs, or Real Estate Investment Trust Exchange-Traded Funds, offer a way to invest in a diversified portfolio of REITs in a single transaction. This not only provides exposure to a wide range of real estate sectors, but also minimizes the impact of any single REIT's performance on your overall investment. Moreover, it's essential to keep an eye on economic indicators. These indicators, such as inflation rates, GDP growth, and employment figures, can give you a sense of the overall economic environment and hint at potential interest rate changes. For instance, if inflation is on the rise, it could signal that an interest rate hike is on the horizon, which might impact REIT's performance. In addition, consider seeking advice from financial professionals. They can provide insights into the current market conditions, help you understand the potential impact of interest rate changes on your investments, and guide you in adjusting your investment strategy accordingly. Lastly, remember that patience is a virtue in investing. The effects of interest rate changes on REITs don't always happen overnight. It's important to stick to your long-term investment strategy and not make hasty decisions based on short-term market fluctuations. With the right strategies, you can navigate interest rate changes and potentially even profit from them. So keep learning, stay informed, and make strategic decisions to steer your investments towards success. Today, we've learned that interest rate changes can have a significant impact on REIT stocks and REIT ETFs. But with knowledge and strategy, you can navigate these changes to your advantage. As we journeyed through the world of real estate investment trusts, or REITs, we discovered how closely tied they are to the fluctuations of interest rates. We've peeled back the layers of this complex relationship, understanding that when interest rates rise, the cost of borrowing for REITs increases, potentially leading to a decrease in their profits, and subsequently, their stock prices. Conversely, when interest rates fall, the cost of borrowing becomes cheaper, potentially leading to increased profits and higher stock prices. We've also delved into the world of REIT Exchange-Traded Funds, or REIT ETFs, which offer a way for investors to gain exposure to a diversified portfolio of REITs. It's important to remember that REIT ETFs are not immune to interest rate changes. As we've learned, a rise in interest rates can negatively impact the value of REIT ETFs, while a drop in interest rates could potentially boost their value. Throughout this exploration, we've emphasized the importance of understanding the impact of interest rate changes on both REIT stocks and REIT ETFs. This isn't just about knowledge for knowledge's sake. It's about empowering you, the investor, to make informed decisions that can help you navigate the ever-changing financial landscape. We've also discussed strategies for navigating these interest rate changes. Remember, it's not about trying to predict the unpredictable, but about understanding the potential impact and being prepared. We've highlighted the importance of diversification, not only across different types of investments, but also within the realm of REITs themselves. By diversifying your REIT investments across different sectors and geographic locations, you can potentially reduce the impact of interest rate changes on your portfolio. And let's not forget the role that research plays in all of this. Staying informed about the latest developments in the financial world and understanding how these changes can affect your investments is key. Remember, knowledge is power. In conclusion, the world of REITs and interest rates is complex, but with understanding and strategy, you can use these complexities to your advantage. The impact of interest rate changes on REIT stocks and REIT ETFs is significant, but it doesn't have to be intimidating. With the right knowledge and tools, you can navigate these changes and continue to invest intelligently. Thank you for joining us on this journey into the world of REITs and interest rates. If you found this video helpful, don't forget to subscribe for more content like this. Until next time, keep investing intelligently.